Objective. At the end of the lecture, you will be able to describe the differences between the cross-sectional and time series analysis, illustrate the usefulness of the ratios, explain the two categories of financial ratios, calculate and interpret selected financial ratios. For today's lecture, we will touch on two categories. In lecture 4, we will touch on the other two categories. Lecture outline: definitions, importance, and basis of ratio analysis. We'll touch on this. We'll touch on two categories of financial ratios today. One is liquidity ratios, the other is activity ratios. What's the focus and purpose of ratios? This will analyze financial statements to determine the financial health of the business. Who is really interested? The management, creditors, shareholders, fund managers, governments, and auditors. Ratio analysis is a part of the analysis of financial statements. It involves methods of calculating and interpreting financial ratios. For what purpose? To analyze the firm's financial performance and positions. From the analysis, we will indicate the symptoms of problems for further investigation. Let's look at a simple example here. A student's 1.8 CGPA bracket ratios indicates his academic health is not healthy. 1.8 CGPA is the symptom. It requires further investigation. Real problem could be due to either laziness, poor time management, BGR, or health issue. A meaningful basis for comparison is needed to answer a question like, is it too high or too low? Is it good or bad? Basic inputs to ratio analysis are figures from profit and loss statement and balance sheet. Regarding cash flow statements and notes to account, we will not cover here in this lecture. Data are taken in absolute terms. For example, net profit 50 million. You will take the whole 50 million as net profit, the absolute figure from there. Or in ratios like net profit margin 14% is to be compared for trend. One main advantage is it brings the figures down to a common scale for comparison. Without a common scale, it's hard to compare a meaningful comparison because all the figures are different and they are all based on different scale. So to bring down to common scale is useful for comparison. Using time series analysis, this compare from one year to the other year, and cross-sectional, compare against among companies. So time series analysis involves comparing ratios of the same company over time. So it's one company over a period of time, over a period of number of years. For example, comparing the same ratios over a period of years will show the trend. Is it going up or down? Is it improving or worsening? Let's look at OCBC here. We look as an example. We have the figures from X9, from the year X9, X10, X0, and X1. So basically, you can see from here, the revenue, the net profit before tax, and profit margin. So what's profit margin? What's the profit margin trend? You can see, compare X9 and X0, the revenue has increased. And X1, the revenue has increased further from 3.6 billion to 4.3 billion in X1. And the gross profit margin has increased from 26.9% to 31.8%. This is a good trend. However, in the final year, right, the final year is X1, the gross profit has decreased. So the answer is the profit margin improved in the year 20X0 and declined in the year 20X1. Cross-sectional analysis, it involves comparing the ratios of different companies. Take note, this different company at the same point in time. For example, the ratios of a company may be compared to its competitors, the industry leader, or to industry average ratios. Normally, industry average ratio is more common. Let's compare the three local banks, DBS, OCBC, and UOB. By judging on the revenue, the UOB has the highest value, 6 billion, followed by OCBC, 4.3 billion, and UOB, 4.2 billion. Which is the best bank? How do you judge? By total revenue, profit, or profit margin? Which bank has the best profit margin? We can see that DBS has the highest profit before tax, but the one has the best profit margin is UOB, standing at 2.85%. So the answer is UOB. Time series analysis involves same company over different period. So basically, we have 3 years. We can look at this example. We have gone through the example. We look at the trend over the past 3 years. Whereas cross-sectional is look at different company but same period. So we have compared the 3 local banks for the same year. So comparing these two analyses, to both are important. Okay, just that it depends on what you are looking for. How do you use the results? The results of ratio analysis tells you the symptoms of the problem, but not the cause. So further investigation needed to be done in order to isolate or identify the cause. Users should investigate both positive and negative deviation from the standard. Usually they look at, they trace it against the industry average. For more meaningful analysis, both time series and cross-sectional bases should be used. So you should use both of it to see a bigger picture. Any questions so far?